Stepping out a little late, but what the heck, you have to start doing this, and I will. So that's about it. So it is a very good time to start reflecting on what's really happening in markets here, because what we've really ended up doing is getting a major upside boost simply based on what is election results, and that's not always a good place to start, because of course this time I think this has been one of the biggest positive reactions to the election results that we've really ever seen, or that I can really remember in a long time. And I don't think we'll see something like this again. And that I'm talking about state elections, okay? So don't compare this with general elections. In fact, even when it comes to general elections, what we saw in 2004 was the first time we had the huge negative reaction to a general election. It had never happened before. We had many governments come and go, coalitions, but it never led to such big gaps, 5, 6, 7% moves overnight. And the same thing then in 2009 on the opposite side, when you had a gap up and a runaway. So this then became the new norm, elections having a major impact on markets. But state elections had never done it, and now you have state elections having an impact. And so this is a little crazy. I don't know how much of it is. In fact, I think it's all sentimental, because like I'd already mentioned, the positioning throughout November was extremely short. FIIs had the second highest short position on record, at the start of the month. And therefore that is an insane level to really be starting. And if you start at that kind of level, what happens? Now, my only concern was that at the end of November, they had not really cut much of their position. And the last time that had happened was COVID, and then the crash happened. But COVID was a reason. Moment it showed up, the shorts got paid. This time around, what was going to be the reason? Now, there is a reason, and that is the US recession, but it's still not on the table, and therefore nothing has broken. There was no such credit event that could announce and be a cause similar to COVID. And so probably on that basis it was fair to expect that the shorts would eventually get covered. But I did get cautious at 19,850. However, the day it closed above that, I flipped. That's something that's hard for a lot of traders to do. I know, I've been there, done that. Sometimes even I don't flip fast enough, but I've learned over time that that's the only way. That if your readings say that, okay, if not this, then this is the next thing, then if you flip, you get paid. In fact, even in October, when we broke 19,600, that's sort of what I did. I flipped. I told myself I should flip. I flipped, traded the opposite side, and the market sold off, and you get paid on that short trade down to 18,800. So the same thing here. This was a good trade up till the Monday's gap up. After that, it's hard to say. Will it last for 2 days, 3 days? This has been, like I said, longer and larger than anyone before. So based on history, surely you couldn't have said that this is what would be the outcome. But here we are.
A quick message for our viewers before you continue with the video. Indiacharts Mentorship Program with Mr. Rohit Srivastava is starting this January. If you haven't signed up for it as yet, you can by calling us or sharing an email with us on the details given on the screen. I will also have a link given on the description for you to access the mentorship program directly. This is our annual batch, the only batch we take once a year with Mr. Rohit Srivastava. So contact us to have an in-depth and complete learning about how to approach the markets. Thank you so much and enjoy the rest of the video.
Am I out of that trade? Yes. I've given up on it. I've given up because it's not a give up. It's just like, why shouldn't you? And if you're trading, if it's a trade, book your gains. That's the oldest thing on earth, right? Who's going to tell you that booking gains is a bad thing in a trade? Investments are different. You try to take a longer term horizon, but there is a way to really exit an investment even with a lag. We explain that a lot to people in mentorship. I've found so many people coming up with that question, will I really be able to learn how to exit an investment at the right time and hold on to it for the most, because a lot of people get out early, and that I think is a big learning that people can take away. It's very simple system, methodology, but it's just that you have to start believing in it, seeing it, and then executing it. So everything comes down to execution. So where are we in the markets today? I think time to be very cautious on the trade because the daily RSI is high at around 89. The hourly RSI is also in the 80s. So it tells you that, okay, some kind of short-term pullback is the starting point. But will it become a bigger reversal? Are we looking at a top? That is something that it needs some additional thinking. I cannot completely rule it out. The risks that were there at the start of November are still there at the start of December. And so that simply means that don't completely give up on the risk and the eventualities that come. One of the things that has started to happen in the last week that can pose as a risk is a rising dollar. Right? It's not gone up much, the DXY, but last 2 days it's traded. I think yesterday it managed to close above the 20-day average. I wrote a post of that in Indiacharts Insiders that, if you actually cross the 20-day, then probably what we are talking about is a dollar rally that can extend higher for a couple of weeks and can create some kind of a risk off. Now, note these macro relationships don't always work on a day-to-day basis. Sometimes there's a lag, and then I really go by what your market itself says. So dollar may be rising, that doesn't mean short tomorrow morning, but be aware if there is a signal, if the Nifty does give us a signal of a reversal or turning down, we cannot ignore it now. In any case, trades are booked out, investment thesis needs to be thought of, and if there is a further trade to the upside, we look for a consolidation. That's the magic word. Consolidation simply means that prices don't break down, they hold up, and every pullback ends up being a corrective. In Elliott wave terms, it means ABC down, just like the big correction in October was ABC down. Even the small ones need to be ABC down if your overall perspective needs to remain positive. And so if you get that ABC down on an hourly chart, on a daily chart, it holds key levels and you start moving up again, then you're good for the next trade. Just like 19,850. Of course, you don't buy at 19,850. It closes above that. You buy at 19,9 something. You ride it till 20, whatever. You get out. You think again. Now, there are times you could have ridden the whole thing. In fact, technically, nothing broke actually, except for fear at 19,850 that something could go wrong. But the shorts had not covered till the month of the November expiry happened. And then overnight, they gave up a lot of their shorts down from 1,37,000 to around 56,000 contracts it came down to. And now in this rally of the last few days, it's finally gone positive yesterday evening. That is after yesterday's trading. FIs are now long. Some, I don't know how many contracts it was, few thousand contracts, I guess. But that's a change in positioning that has finally happened. And so the short covering is over. What is not over is that do you really turn into a long trade over here? So if you turn into a long trade, then you might even reach the long extreme. The client side positions have already reached an extreme. So if you're a user of Strike Analytics, web.strike.money, for those who have still not seen it, go there. Look at the sentiment indicators. Client positioning has reached the lower red line, which means the max short position or near max, the first level of max, not the second yet. The FIs have still not, oops, there goes the planes. Yeah, that's the one thing about being in this area near Juhu Beach. The other day I was walking around the beach and you had two planes fly by. So you're close to that zone. The moment I walk, you get that noise in between. I don't know if it comes on the phone or not. But so going back, the client side position is getting to extreme. The FI positioning is still not at the extreme long side. It's just crossed over the zero line. So it has some room to go. I think it was around 25,000 contracts yesterday long. So we still need to go to say 50,000 or 100,000 before we can really say that this is done. So that's the setup. Cautious on trading, waiting for confirmation that there can be upside or this is a reversal to the downside. Investment side needs thinking. This is a good time to think because at the start of 2023, I had this one view. 23 is going to be all bullish. And the other one that the so-called US recession based on the inverted yield curve can actually get delayed, because the yield curve inverted last year and it's an early indicator. It can be 6 to 12 months ahead of the actual event of a recession. That's something that's already been proven in previous cycles. So you just can't say inverted and say, oh, tomorrow you get the recession and sell off, because the recession means US equities can fall up to 30%. That is a risk. But the question is when. And that's where the timing comes in. So inversion has been there for all year long. Steepening is what should scare us. We steepened a bit in October. Again, it's cooled off from there. But we are done with a year since the inversion. And that puts us closer and closer to the point at which we will end up taking that decision that we are probably hitting the point where markets start responding to the potential risk of a recession. So that's what it is. Now, as we enter 2024, a lot of the research that I read saying that the slowdown will hit at some time in 24. Again, a lot of people say early 24. Some say as the second half of 24, which means after March. But seasonally, Jan, Feb, March has been a period where there's volatility or there are many major corrections, tops, and therefore it's a very good time to really start watching about what really happens. That's why I think on the investment side also, it's a very good time to lighten up and take heed of the situation, not to go overboard. You're getting a chance to sell at the all-time high levels. You rarely do. So I did lighten up in October when I got scared. I went in again and I'm lightening up again. So out of trades and watching the investment scenario, creating cash so that you can always, pick things up when the dust settles. So that is the approach. And the main risk, like I said, the dollar started rising. Will that risk really play out in terms of causing a sell-off? You're seeing that in commodity prices. Big sell-off in copper over the last 3 days. Silver, mostly non-precious metals. Of course, silver is a precious metal, but silver tends to sometimes fall with the rest of the commodity pack much more than gold. Gold is still above the 20-day average. Silver and copper fell harder. So did oil. Oil is still in a free fall. I wrote about that 2 days ago. The lower end of the channel was closer to $72, $73. Now we're getting close to that. Let's see what happens. Tough scenario as far as commodities are concerned. And you have a falling bond yield and a rising dollar. That is a risk off trade. If you had a falling dollar and falling bond yields, that would be a risk on trade, because that would mean rates are coming down and liquidity is really moving out into various assets, whether it's commodities or emerging markets. But right now we have the reverse setup. We have falling bond yields and a rising dollar, which is a sign of caution. Another interesting one, which has kept us on the hook for months now, is India VIX, right? India VIX has been knocking at the doors of 12, 11, 13 for months and months, and last 3-4 days post this election event, which is very surprising, because the election events tend to typically be the ones that should have led to pricing volatility, because volatility is something that rises ahead of events. But the state election did not really cause VIX to go up. After the state election, last 2 days, the India VIX is going up. Now, I don't know what it is pricing in. I'm sure that the RBI meet doesn't get more volatility risk premium than, the election results. That would be bizarre. So I think it's something else. The VIX is finally making an attempt to break out. It's already gone past the 6-month high. The next major hurdle is close to 14. I have seen it, pause, take support at 14 many times when the India VIX is falling. So I've put that as a support resistance line on my chart. So if we go above 14, that would be one major hurdle, one major level getting really taken out by the India VIX. So that's, I think, in a nutshell. Many small things. Last risk I'll leave you with. Probably spoken about it in all my recent interviews, and that is the USD-INR. Yeah, we speak about the dollar rupee. What about that? The dollar rupee has been knocking on the doors of 83.5 for months. no matter how much the stock market goes up, the rupee doesn't get stronger. Now, this is a pattern we've seen all through 2021 also. When I was bullish, the markets went up. Nifty went from 10, 12,000 to 18,000. The USD INR or the rupee stopped appreciating. USD INR stopped going down. And so there was a divergence for months. You just had to ignore it or probably trade the USD INR as an independent trade, not really correlating it with Nifty. Surely in the short term, there's an inverse correlation. So when the market goes up, the USD INR remains flat. But the moment the market pauses, the USD INR shoots up. So in other words, we've been net depreciating. And we are once again knocking at the doors of 83.50, which means the moment the stock market stops going up, the USD INR goes up again. And the only way the RBI can stop that from happening or slow it down, and if you're a student of economics, you should know the answer. It's raising interest rates. Unless they do what they did last year, which is dump $100 billion on the market. I don't know if they can do that every time. Every year cannot be a strategy ki, dump your reserves on the market and keep the rupee from depreciating. That strategy worked last year. It just kept the rupee below 83 for the next 6 months. Note, it didn't get strong again. So that's the level of weakness we have, that even $100 billion just got it to stop, not even go back. Now we are knocking at 83.50. We're not going to stop or go back unless they sell another 100 billion and keep it here for longer. I doubt it. They will, loosen up the strings that much. This time the solution against the currency is going to be to raise rates. So if the USD/INR breaks out, don't be surprised. The RBI will raise interest rates. Blame it on inflation or something else. But the purpose is going to be currency management. I think that's the main reason why in the last meeting they also said we will sell bonds. I was surprised and I linked it to the currency. They will never accept it publicly. But I cannot see any other logic why you would do that and bump up yields a bit, except for currency management. So currency remains our biggest risk because with FII flows remaining mostly negative, forget the last 10 days, mostly negative for 2023, 22, 21, 3 years consecutive. That's not a good sign. You don't have the currency flow that you really need to support your current account deficit. And that's always going to keep the currency under pressure unless we can get significant flows on the portfolio side. And I sense the only reason for that is the withholding tax. Too many people thought interest rate differentials. FIs have been sellers for 7 out of the last 10 years. It's not the interest rate differential. That's only a recent problem. It's the withholding tax. And probably some of the restrictions on trading in the derivatives market, that is Nifty, futures, SGX, all that has probably added up in the indifference towards our markets by FIs, or rather at least new flows coming in and in large numbers. If the tax, because a lot of these FIs, what they do is they just look at tax havens. If they can find a way to invest tax-free through PN notes, through, where you have tax-free agreements, they'll route it through those Cayman Islands and all. But if somehow we plug those loopholes, then suddenly you won't get that money because FIs don't like to pay tax. So I think that's it. That's the net problem. We have a couple of problems to deal with. That doesn't mean that markets can't go up. They go up when liquidity is strong, when growth is strong. Then they ignore a lot of these factors. But these factors do come back and impact the market trends. And that is the situation we are in right now. Thank you.